Shares of Instacart now up more than 20%. It does lift its valuation to about $14 billion.
Hey everybody, my name is Matthew and welcome back to my channel. Today we have some pretty breaking news in the tech and stock market world. Instacart, the very popular delivery service for groceries, has just gone public and there has been quite the roller coaster for the stock price. So let's dive right in and understand why the stock price of Instacart has risen and fallen. We really just want to understand what's happening, what's going on. So taking a look at the screen, we can see that Instacart's stock performance has not been doing too hot. Instacart's journey in the stock market hasn't been the smoothest as expected. Their shares fell more than 5% on the second day of trading, continuing a downward trend that started right after the stock debuted on Tuesday. So let's go into Instacart's IPO details. Now before we get into any recent developments, let's take a look at Instacart's initial public offering or IPO. The company offered shares at $30 each and under the ticker symbol CART, which saw an impressive 40% gain in the first day of trading, all the way up to $42 a share. However, this excitement quickly faded to about $33.70 that same exact day. Now in the following days of trading, Instacart stock actually continued to sliding all the way down to $30.10 on the second day of trading, leaving it just about at its IPO price. Now this decline has really raised concerns among investors, especially those trying to invest in riskier assets where we're looking at challenging business models that are in the tech industry. Now to better understand what is happening, let us take a look at expert opinions and insights. So Gene Munster, the managing partner at Deepwater Asset Management, shared his skepticism about Instacart's performance in an interview with CNBC's Closing Bell. Let's take a look right now.
What does an investor kind of need to know about how it's valued today?
I think the first thing to know is that the action that we see in the stock today is misleading. And this is a well-orchestrated pop that's typical with an IPO, obviously working with the float and some of the excitement. So I think when you think about the investment case of Instacart, let's just block out the fact that it's up 20% today and ask the fundamental question, which is, what is the growth story? They are positioning themselves as a tech company. What is the growth story? And their fundamental business today is delivery of groceries. They own that market. The amount of groceries that have been bought online has increased dramatically since pre-pandemic, from 3% in 2019 to 12% year to date. So that's a great business for them, but their unit growth, and this is the pressure point, this is the most important factor that investors should be focused on, has been flat year to date. So the order growth has been flat. So this grocery business, even though it seems to be a big opportunity, it just isn't yielding the critical metric of order growth. And their response to that is they will use an omni-channel approach and vector into local great products, like their relationship with Dick's Sports to deliver sporting good items. And unfortunately for Instacart, this is the same playbook that Uber and Dash are using. They're each coming from a different area of strength. Instacart is grocery, Uber obviously rides, and Dash is with restaurants. And I think as the bottom line here is this, the question that investors should ask today, do you believe order growth will reaccelerate? My view on that is I think that it will improve from flat, but it's not going to be as exciting as Uber.
So Munster expresses initial concern of the IPO just popping on the first day, labeling it as misleading. Now this is a typical phenomenon for an IPO where they'll just go up in the first couple trading days and then they'll just start crashing. He highlighted that Instacart's unit growth has remained flat to date, questioning whether that order growth is going to keep growing or reaccelerate. Now adding to the skepticism, analysts at Needham issued a hold rating for the stock, and that's anticipating that the stock's growth might face some challenges in the upcoming years. They even emphasized potential difficulties in post-pandemic online grocery sales and cited structural headwinds against adoption. Now let's take a look and zoom out a bit and just look at the broader market trends. Instacart is joining a league of gig economy companies that have gone public within their most recent years, including Airbnb and DoorDash. However, among them, Airbnb has only been the one to prove that they are a good investment for shareholders, with DoorDash being still below its IPO price. Interestingly enough, following Instacart's debut, marketing automation company Klaviyo also hit the market. The stock initially saw a 23% rise and going all the way up to $36.75 a share, which experienced a slight decline afterward. But like we know, all IPOs go up and they all come down in the first coming days. So in conclusion, Instacart's stock market performance has really been keeping investors on the edge. The trajectory of their share prices has begun to signal to investors that this is a riskier investment and to be more cautious. Now this is a reminder that even though there's tech companies that are disrupting traditional markets, we still have to consider that these companies that are still in the stock market today aren't always guaranteed to generate us a great return, and we just have to price that in. So that's it for today's update on Instacart's stock market journey. If you found this information helpful or informative, please leave a comment, like down below, and subscribe. And if you want to see more content around finance, investing, or technology, make sure to comment down below and let me know so I can make more videos on that. Thank you guys all for watching, and I'll see you in the next one. Peace.